Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Bruno, good to see you.
Good to see you, Paul.
Tisa, welcome again.
Good morning, Paul.
Ramsey, good morning.
Always glad to be here and very excited about today's conversation.
Yeah, as am I. So last episode, if you didn't listen to it, you should. We did a really I thought we did a good job talking through some of the themes and topics that were of significant importance in 2022. And I think when we did some of these shows, we didn't realize they would be as important as they would. And timing was perfect. Okay. Our guest today is Mr. Scott Hawkins, who is the Managing Director and Head of Insurance Research for Conning. Scott, welcome.
Hey, good morning. Welcome, everybody. Glad to be here. Yeah,
and it's been a while. It's been 2 years since we had you on our show.
2 years since I was last on here, yeah.
Wow.
Unbelievable. So, well, first of all, thanks for coming back. And we're also looking forward to an event you will be keynoting for us in March. We're going to be doing another retirement innovation program called Retiretech. I think we'll call it Retiretech. I don't know, 3.0, Ramsey. 2.0, I don't know, 2.5, 3.0. But first and foremost, Scott, maybe you could just tell us first, we talked about this just briefly before the show. Tell people who exactly is Conning, and then let's talk about your role and kind of dive into what this year may bring.
So for those of you that don't know, Conning is a global asset manager, been in business for over 110 years, primary headquarters in Hartford. So from that, you get the sense that our primary focus, and it is true, is servicing the general account assets of insurance companies, life, annuity, PC, and health. That said, over 110 years, we've become global. We're in Hong Kong, Taipei, the UK, Cologne, outside of Denmark. One of the ways we have been differentiating ourselves for at least 50 plus years in the marketplace against other asset managers is providing a really top level strategic research aimed at the C-level executive to help them understand what's going on in their market, in their products, and what's driving profitability and what's changing the risks they're facing in terms of profitability. So we've been producing this research for our asset management clients. We also make it available on a standalone basis for non-asset management clients. But the ultimate aim is to help that executive understand what's going on in their marketplace, what should they be focusing on, and how does it affect their bottom line? Because for an insurance company, at the end of the day, bottom line is what matters.
And it goes far beyond that, of course. I mean, the asset allocation is not just, one check the box item for every insurance company. It's the key fundamental of to your point of bottom line, but also of balance sheet strength, company strength, capital requirement, and that drives many of the stories. And that's going to be a good segue for our conversation today.
And to your point, Bruno, if you're managing the assets, that you'll hear the phrase asset liability matching. That's the approach that insurance companies generally take. But for the asset manager, you have to understand what those liabilities are, how they're changing. Those liabilities vary by the types of investments that you have, as well as the types of products you're offering and the risks associated with those products. And ultimately, you need to come up with an asset strategy that matches those liabilities for that individual insurer, which may be different from another client that you have.
So Scott, one of the things that we were talking about ahead of this discussion was really about trends in the market, trends in the annuity market, and a critical element around that is one of capacity. So very, very interested to hear if you can share with our audience, where you think the market is in terms of capacity and what sorts of trends we're seeing to increase capacity in the life and annuity space.
Yeah, so Ramsey, one of the things that we produce is, as I mentioned, the types of research. One of them is a 3-year forecast for all the major lines of business: property, casualty, life, and annuity. So what that means is we're looking at 3 years down the road right now through 2024 of the full income statement for the individual annuity line at an aggregate level, right? And that's based upon statutory data from years before. We keep track of all that. So in our forecast that we produce at the end of the year, we're looking at the individual annuity market, and we're really seeing a market that's really being set up for growth and profitability overall. When you look at the factors driving premium, there's a lot of them that are really positive that we see. A lot of them you've talked about on your show in the past. There's a demographic wave that's coming in for the senior market. As more people are retiring, they're going to be looking to somehow generate a secure retirement income from their accumulated IRA and 401k assets. You certainly have Secure Act 2.0 that's come into play, which is really attractive for a lot of the younger plan members. It's going to open up a whole new opportunity for them. When you look at DB plan members, we're looking at the possibility of continued growth for pension risk transfers coming in, all of which comes in at a time when interest rates are improving. And when interest rates are improving, the spreads on fixed income annuities, fixed annuities, index annuities are improving. So that's why you're seeing the growth in crediting rates on those products. That also means that the insurers are making a little bit more profit on the net investment income. Net investment income, for instance, accounts about 25% on average of the total revenue that an annuity company generates on a year in, year out basis. The fees on separate accounts are about another 10%. So we're looking at a situation over the next 3 years where there's a really strong potential for growth in premium. You start to see a bit of that this year in 2022. We think that's going to continue, which means ultimately a profitability. But the thing about the insurance industry is it's a regulated environment. We're adding these liabilities on, these guarantees of investment returns, the ability to pay a income stream for life if you have a SPIA that you've purchased. And if you're going to have a wrapped product, guarantee the ability to pull those withdrawals out. All of those create a certain amount of risk, which the insurance company bears. And in order to remain solvent, the regulators wisely created a capital structure referred to as risk-based capital that sort of reflects the risk that the insurance company has assumed in terms of investment risk and product risk. And insurers have to maintain capital levels in order to remain solvent and make sure that the regulators don't come in. And for us, to your point about capacity, if you look at the size of the opportunity created by Secure, created by the fact that there are boomers looking to retire and monetize their IRAs, you're talking about a multi-trillion-dollar opportunity. And right now, the industry, the individual annuity industry, is leveraged at about 10 to 1, which means there's about $1 of allocated capital to every $10 of general account annuity liabilities, right? So there's about $1.9 trillion of general account annuity liabilities. That's what we've estimated. And when you compare that with the opportunity that could come in from all of these factors that are really positive for growth, that leads us to the question, is there enough capital to support that if it all happened all at once? And that's an area we've been looking at since starting in 2011. I first did a study on that when the first boomer turned 65. So we think that this issue around capacity is going to be resolved, but there's going to be a wide variety of ways that that's going to happen. And we've already seen some of them emerge over the last decade. So I'll pause there if there's any questions.
So how did you react to it? I mean, you started that study back in 2011. Mm-hmm. We all know the inflow of capital that has been taking place in the last, let's say, 12 years in that period. How did that stack up against your forecast and your prediction of capital availability in the market?
Yeah, in 2011, the conclusion that I made in that study was that we were looking then, so this is pre-Secure Act, but we were just looking at the demographic wave of boomers moving in, and we said if everything were to happen, there wasn't enough capital to support that. As a result, our conclusion was that the annuity industry and annuity insurers were going to have to look outside their traditional pattern of capital growth, which is their operating results, to find third-party capital to come into the market that would be attracted to come in. And sure enough, a couple of years later, you start to see the emergence of these asset manager and private equity-backed reinsurers who are coming in and either doing reinsurance treaties or issuing new paper out there in the marketplace. And that influx of third-party capital has been continuing, and the dynamics of that market shifting. we were talking a little bit earlier that one of the changes is that we've seen the rise of all these new players in terms of sales ranking because they are actively out there trying to grow liabilities, while some of the established players are looking to perhaps scale back because they have large blocks of business. So clearly bringing new capital in was what we concluded. We've certainly seen that happen, and we've been tracking that ever since then with a multiple series of reports. And this year, what I'm really looking at in terms of new solutions that's emerging on the life annuity side is the use of sidecars, which have been very prevalent on the property casualty side for a long time. And if you're all familiar with the sidecar and how that's working out.
Yeah, why don't you explain it to listeners? Because, of course, we are experts on sidecars. Scott, with the wink. Said with the wink.
So if you think from the property casualty world, right, they're insuring a lot of natural catastrophe risk. So the issue around how do you make sure that you have the capital capacity when you have a Cat 5 hurricane hit Florida. One of the solutions the P&C industry over time came up with was insurance-linked securities, where they could bundle up risks and sell them off to the capital markets, but also what's known as a sidecar. Now, in a way, a sidecar is a way that third-party capital, institutional investors, can participate in the reinsurance space without actually forming a reinsurer or investing directly in the insurance company. So what will happen is there will be a reinsurance company created, and then there will be a third-party institution. Apollo's created one, Global's created one, Kuvari recently created one, where they go out and they raise capital from other institutional investors, along with some of their own capital, to supply additional capital support to that reinsurer as it takes on more business. And then if you're a primary insurer, if you're out there writing new annuity contracts, or if you have a block of existing fixed annuities or index annuities that you want to move off your balance sheet so that your existing capital can be redeployed, you can move that to that reinsurance company, and that reinsurance company then can tap the capital in that sidecar. That's why it's often referred to as a sidecar. The investors over time, they earn their return on the investment and the profitability of the reinsurance company. And for that institutional investor, they're not fully tied to the underlying success of the insurance company. If they want to liquidate their part of the sidecar at some point in the future, they can. So it's a more liquid structure for an institutional investor who wants to assume some of the insurance risk and return without directly investing in an insurance company or a reinsurer. Long way of saying it's a new source of getting capital. It's been around on the P&C side for a long time. For the last couple of years, we're now seeing it move into the annuity space. And we think that will be a very attractive opportunity for institutional investors and provides another way to bring third-party capital into the annuity space to support the growth opportunity.
Yeah, so, this business is just, as Scott, as you know, so counterintuitive. Ramsey, Bruno, Tees are right. It's, interest rates going up are a good thing. They went up too fast. That was a bad thing. Our bonds just got marked down. No, so it's my mental model, Scott, is generally there's some good things that happen in this business, but if anything happens, even if it's a good thing, and it happens too quickly, it's usually a bad thing. So what are some of the quick shifts we could see in this market? Maybe we can play out a few scenarios. One is interest rates get, recession hits hard, and interest rates spike even more than we've seen. We see. What are the implications here for the annuity outlook if that happens?
So for the annuity outlook, you can look at for the retail investor, you're probably going to see an increase in crediting rates to attract business, right? That would go up. But to your point, if a particular company gets too far ahead and starts really seeing an influx of new sales, they have to reserve for that. They have to have the capital capacity to support that. So they'll be monitoring that at an individual company level, right? But for their assets, that creates some pressure on them because as interest rates go up, most of the holdings of an asset in a life company are in fixed income securities. interest rates go up, your existing portfolio values go down a bit. There's reserves to help offset some of that. That's the good news around that. The other challenge is you're looking at what we refer to as the overall portfolio rate, which we've been since 2010 and 11. We started tracking the portfolio rate for the individual annuity business, which is we say our actuaries and our teams were to say, here's what's rolling off at an aggregate level in terms of liabilities, and here's what new sales are coming on, and here's what the interest rates for the 10-year are. And that gives us an indication of sort of where the portfolio rates are headed when you look at like Philly Fed surveys. Until this year, the end of this year, that portfolio forecast had always been going down. And it was like, I know you've talked about the low interest rate environment. That puts pressure on insurers to be able to afford to offer fixed income annuities or immediate annuities because they were under spread pressure. Now we're seeing that portfolio rate swing positive and start to recover. So in that scenario, interest rates spike. The insurers that will be bringing money in will be investing at higher rates rather than at lower rates, even as older fixed income securities roll off. So that'll be positive for investment spreads, enabling them to support more profitable products, may encourage them to actually go out and write more business.
So
that's the rising interest rates scenario.
Yeah, so that scenario would probably favor some of these companies we haven't heard of until the last 2 years. The ones with the smaller in-force block and they're writing de novo. Scott,
Yep.
is that?
So I want to put a further lens on that because I think it's super important, right? So we have a lot of factors that are going to translate into much greater demand. There is sort of this historical capital constraint. You've got legacy players who are structurally more inclined or structurally philosophically more inclined to grow in a more measured way. And then you have these new entrants that are incentivized to grow much more aggressively and quickly. Now, what's interesting is that sometimes, depending on who you talk to in the industry, there are different attitudes. There are different attitudes about the new third-party capital providers. There are some that would say, well, they take too much risk in their portfolios. There's various debate. Some of it's marketing noise. Some of it's reasonable sort of questions. But I think that the overriding theme here is that we don't have any choice. Like, for this business to work, and let me know if you think you would agree with this statement or if I'm overplaying it, but it doesn't seem like that this works, that the industry reaches its full potential unless we have those third party providers. Like, we need them. Full stop. Is that fair?
Absolutely. That was what we saw in 2011. It still holds true today. Yeah. It's even more so because if you think 2011, we're just looking at the potential retirement of the boomers, and that silver tsunami, as we were referring to it back then, coming down. What would that happen if their assets started to annuitize? Now you've got Secure Act, which has opened up a whole new avenue of growth, as well as pension risk transfers, which have been a growing business as DB plans look to offload their retirees' liabilities onto an annuity company. True, that's usually done on a group basis, but still that consumes capital. So to your point, there's great potential ahead for growth. The constraint is going to be, will there be enough capital? And if the solution to that is you're going to have to figure out a way to effectively tap third-party capital, institutional investors to come in. And yes, these new companies, these new entrants, there's people that like them, people that are concerned about them. To your point, some of that concern is valid. Others, though, might be for their own reasons why they're against it. Things like these sidecars, though, are another way of doing it. Because when you just look at the overall, if all you were going to do is grow based upon your organic profitability, and the individual annuity line overall has been profitable about at an aggregate level, and that's about, on a stat basis, about 19 billion a year on average. Some years a little bit more, some years a little bit less. But that's not enough to support the opportunity. And you can sort of say, well, not everybody's in a 401k is immediately going to move everything in. Not everybody with an IRA is going to immediately go out and buy a SPIA. That's certainly true. but just the amount of assets in those areas, some of those will, and they're going to be encouraged to do so by financial advisors, by plan sponsors, by the broader media as you're retiring, to think about how are you going to generate a guaranteed retirement income off of some of your assets. And that's going to lead and open up the discussion around, well, maybe we should consider an annuity somehow. And that's even before you start thinking about the people who are younger employees joining a 401k. If they're put into a annuity-like product, because I see a lot of innovation coming along there, and I'm not quite certain what that will look like, but that's why I refer to them as annuity-like. Those types of assets will start to build over time as well. So I think this issue around capital could be a big constraining factor on this really strong opportunity we see for growth.
I have a question. Oh, go ahead, Bruno.
Go ahead, please.
So kind of on that theme of the constraint of capital and growth and the new products out there, I guess I wanted to go back on this idea of the generations, right? So you talked about 2011 being important as the first boomer turned 65. So now we're like, 10, 11 years into that. So my question is, as we look at the boomers, maybe approaching that age 80, the oldest boomers, right? Like, what does that picture look like? What are the demands there? They've been living in retirement for about a decade. They're reaching older ages. Maybe there's healthcare concerns, medical costs, those kinds of things. And right behind them, right, the oldest Gen Xer is starting to hit retirement or has maybe 5 to 7 years left to plan better for retirement, given what's happened in the last 10 years. So, products, trends, like, do both generations have the same demand, or is everyone focused on that guaranteed income, or do the product types start to shift based on the generations?
There is a definite generation difference. For that older age group, I mean, one of the areas we look at is we refer to it's the senior market, which is a combination of risks and insurance-based solutions that are offered there. Income solutions are one, but long-term care, Medicare supplements, or Advantage products around there. And there's distributors coming into that space and advisors to help that group understand that. And that carries its own set of risks and challenges as well from a consumer point of view. I know you've done podcasts around, some of the health and issues of dealing with an older age consumer as an advisor, But we see that as for the boomers, that's going to be a growing area, and we treat that more broadly in the sense of all these other things that are needed to really meet that generational demand. With the Secure 2.0 Act, which we've been looking at pretty intensely over the last couple of months, really trying to, now that it's out there, really what that means is you can really start looking at Generation X, the millennials, Gen Zs, and sure there's a dip in Gen X in terms of absolute numbers, but the millennials and Gen Zs are as large, if not larger, than the baby boomers. And Secure 2.0 now opens up an annuity opportunity through in-plan annuities in those 401k spaces to those younger consumers. And they'll start building assets, some of them will, through those annuities, which is creating a whole new opportunity for advisors and insurance companies to figure out how do we provide services to that age group, which traditionally not perhaps been a target for a annuity sale because they hadn't accumulated the assets at that point in time. And we think those generations will start to attract some of the attention. Those obviously, though, have always been a factor. If you look at the life insurance business, those younger consumers are usually the prime buying age, 24 to 54 to 64 for buying life insurance. And traditionally, those have been associated with life stages, getting married, buying a home, having a child. Interestingly enough, when you look at those life stages that are key financial decision moments, those are getting pushed later and later. People are getting married later, they're buying homes later, they're having children later. And if you look ahead, that will have to have life insurers thinking about when are we approaching people, when are they going to be receptive to buying an insurance policy. Probably the same is a little bit true for the annuities, but the 401k in-plan annuity sort of eases them into the idea of I'm accumulating money for retirement on an income basis. I hope that helps a little bit.
So you are so preaching to the choir here. At least I'll speak for myself. So I definitely have a clear vision of what that might look like. The interesting thing, though, is that is just sort of the adoption cycle. The adoption cycle has not been as quick as I think many of us would like it to see. And there've been some providers, if you will, that have been trying to do this for 10 years. So a lot of it comes down to who the decision makers are. So in some sense, it's plan participants for in-plan, but really often the key person is going to be person or persons. It's going to be the investment committee or the manager that's in charge of the defined contribution plan. And so I'm curious, in your travels, right, in the work that you're doing at Conning, are you having those conversations yet? Are you seeing plan sponsors sort of start to examine that? Is that a conversation that you've been involved in? Because I think that over time it's one that intellectually you should be involved in, because you guys have valuable information and perspective that I think would be useful for plan sponsors. I'm curious if they're part of your client base yet.
So they're not part of our client base, but they're people we talk with. And the way we've been viewing this is especially true for Secure 2.0. Secure 0.1 gave the fiduciary safe harbor rule for selecting, which was a big stumbling block, right? Secure 2.0 really does a lot more. And in what we've been hearing in our conversations is the changes required to implement these. So think are now perhaps a stumbling block for full adoption. Let me give you an example. Suppose you're a plan sponsor and a record keeper, and you now want to put an annuity product inside your 401k offering. Well, you've got an infrastructure built on being able to do all the record keeping and transaction stuff with a mutual fund company, right? You've got data standards in place that make that efficient and effective to do. You've got to build all that to go into an annuity company. And those are probably going to be different. And if you have multiple annuity companies you're dealing with, is there a standard interface for all of those, or do you have to build one for each time? These are all new questions that we think plan sponsors and record keepers are having to think through and come up with answers and solutions to that. And I know from conversations, I know it's something that Spark is trying to work out on their own, because there's going to be demand from plan members to sort of say, how much am I, I'm hearing about this. My financial wellness app's telling me I should be thinking about this. My statement saying, here's what my retirement income could be based on this. Is there some sort of annuity-like solution for that? So the opportunities there, I think, I'm not seeing a reluctance from, a philosophical reluctance now to include it. It's more of a technical, operational issue. So that will be resolved, but it's going to take a little bit of time.
For our audience, can you tell them who Spark is? So
Spark is a association for plan record keepers. So they deal, it's primarily everybody that, between the plan sponsor for a defined contribution plan and then the fund companies, all those records that have to be kept of your account balances, beneficiaries, transactions, all that. Those are those services that do that. And that's a scale business, so they have to be very efficient at doing that. And they're, being asked, because of this great opportunity, now we have to really start plugging into a whole new set of product providers, solution providers, that we've never really done that before.
Yeah.
Go ahead.
Interesting. And that's a lot to look forward to. But I want to get back on the balance sheet, and you mentioned, that 10-to-1 ratio of liabilities to capital. That makes perfect sense. It's very, very consistent to everything I've observed. You have deferred annuities, index annuities, pension risk transfers, SPIAs. All of those, require, roughly speaking, 10% of capital for a liability block. And of course, I don't want to dumb down risk-adjusted capitalization to this. I mean, there's a lot more on the asset side, on the liability side, that goes into the risk-adjusted capitalization. But what I'm really interested is, and the other thing is, those liabilities are fairly straightforward as well. Again, I don't want to dumb down all the actuarial work that is out there, but present value of future benefits, less present value of future premiums, you have a liability. If we switch that into the context of variable annuities with living benefits, now these have been issued, a few decades ago. Now we're in the time when, technically policyholders can and should utilize them. Those liabilities and those capital requirements for those particular benefits are not as clear as, some of those other more straightforward annuities. Do you have any sense or any views on how those policies are going to play out over the next decade?
Well, first of all, you're absolutely right to sort of carve out the variable annuity space because, a plain vanilla VA without any of those embedded guarantees would typically have a lower capital charge because all the investment risk, which is a big risk factor on a immediate or fixed deferred annuity, that's assumed by the a contract holder. But the moment you put a guaranteed minimum withdrawal benefit or a death benefit, any of those guaranteed benefits, the insurance companies assumed some level of risk. And if you look at the VA business, and I cut my teeth in it in the mid 80s, it's been those changes in those equity linked guarantees that have really led to massive reserve charges when equity markets went down after the Retiretech bust and the tech bust in 2000, 2008, currently with all the equity market volatility. In response, all of the insurance companies that are in that space have really had to up their risk management game in terms of their hedging. It's very dynamic hedging to maintain that. To your point, now if people start using those guaranteed benefits, so I'm pulling out, let's say I have a guaranteed minimum withdrawal benefit 10%, and I'm actually going to start executing that, that has to factor into how they're managing all their options and risk management that's going around that. I think it's also why you might be seeing, as I mentioned earlier, some of those more established players pulling back because they had, a lot of them had very large VA blocks of business, even though they were scaling that back, and they're still on their books, and they're trying to figure out what can we do with those risks. And a lot of these new reinsurance companies have been focusing on blocks of closed fixed deferred annuities or maybe some index annuity flow reinsurance. But it's only recently that we've seen any meaningful reinsurance deals. And I think the reason is if you're going to be taking on those types of liabilities from a VA with all those embedded guarantees, you've got to have, as that reinsurer, you've got to have a really strong risk management game. And when you look at the two companies that have been involved as the reinsurer, they spun out of companies that had very, very large VA blocks to begin with, and they had that capability in-house. Not all of these new reinsurance companies that have been formed over the last decade have that level of capability, which is not to say they couldn't do it. But, to the extent that there are those that can do it, there's a lot of opportunity for insurers, primary insurers, to restructure their balance sheet by removing those. That gets back to the capacity issue. That frees up capital that they can deploy elsewhere. But it's going to be interesting to see if people do start to utilize their GMWBs or some of the other embedded guarantees, how that plays out.
Yeah, well, let me just pull that thread a little bit. I do think generally people criticize the insurance business for not delivering enough value, but then when you always look back 10 years later for some of these products, there was too much value in there, and we end up with a lot of hangovers, disability hangovers, long-term care hangovers, VA hangovers. You mentioned the lifetime guarantee benefit riders. Now, on another podcast that we do called Prime Life, which is focused on consumers, we've been interviewing a lot of people focused on longevity and how long will people and can people really live. And, the technology, Scott, as you know, is changing dramatically. People are changing. A lot of people are doing the right things, exercise, diet, changing behavior that is just common sense. But we've got new drugs on the horizon. Medical technology is improving dramatically. What happens if the actual estimates of our lifespan are wrong. Say we live 10 years longer. What kind of impact does that have with our current generation of products? Has your team looked at this yet?
We haven't looked at in terms of annuities, no. But if you're looking for a parallel for that scenario, look at individual long-term care. When that product came out, there were assumptions about longevity and utilization, as well as interest, that were baked into the pricing. And while they're unlike an annuity, you're paying ongoing premiums, and those assumptions for longevity, those assumptions around utilization, didn't play out the way it was thought when those products were first designed. There was a lot more utilization than was expected. There was a much stronger increase in longevity than was expected. And as a result, if you follow that space, you know that those insurers with those blocks quit writing the business, and those that had blocks are still in there, they're going back and saying, I need a significant rate increase from the insurance commissioners in their respective states, and getting pushback. And think about the VA space when they're coming up with those embedded options 10, 15 years ago, selling those products. There were certain assumptions based on longevity and utilization. And if those don't play out, that increases the risk for the insurer because they made the guarantee that you're going to be able to do that. And It leads back to sort of, okay, what does that do to profitability and also for capital?
Yeah. Hey, well, listen, we're near the top of the end of our time. Bruno, any final thoughts or questions for Scott?
In terms of where capital is going, where liabilities are going, I think that could be a topic for another episode. But no, thank you. Appreciate you coming in and commenting on those difficult issues.
Yeah, Scott, it's great. We always think specifically about products. We don't think about the balance sheet for the industry. Fascinating topic.
I think that, and I listen to the show, and the way I view it, if you're a distributor, if you're an advisor, if you're a consultant, you're absolutely right. You're focused on product differences, how are they playing out and all of that. But ultimately, your client may come back to you and say, I have this annuity that's now just being reinsured by somebody else, or I'm trying to understand why things are happening. And as an advisor, knowing the products, knowing how they play out is crucial, but also understanding what's going on in the broader market and affecting the issuer of that annuity is crucial. So,
Tisa, what do you think?
Well, it's a pleasure to meet you, Scott. Thanks for all of the insights. And I think we have the title of today's episode, The Industry's Balance Sheet. So way to go, Paul. You just came up with it as we were wrapping up.
Yeah. Ramsey.
Yeah. Well, so many things because it touches on so many areas of interest for me. I think just a number of things. One is I think that we live in a world where the difficulty of basically providing the risk coverage and getting the capital capacity is underappreciated by the market, right? And I hope that whether the big people that are listening to this and others sort of understand, how difficult it is to price risk, and and ultimately provide what are critical services for this country, and beyond that, how much third-party capital we need to come into the space in order to essentially meet, our, America's need, if you will. And so I'm very hopeful and excited about what the future holds, and really appreciate the perspective you gave on how we need to get there.
Thank you all.
Yeah, thanks, Scott. For people who want to learn more about Conning, get access to your research, connect with you, what's the best way?
You can go to conning.com, and there'll be a link right down to our research, which will tell you how to get a hold of us, either via phone call or through email.
Excellent. All right. Well, Scott, we look forward to having you on center stage at our event in New York.
Looking forward to that.
March 27th. More details to follow. Bruno, thanks. Tisa, thanks. Ramsey, thanks as usual. And listen, give us feedback, and look forward to having you join us again next week for another episode of That Annuity Show. Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.